Welcome to the Deep Dive, where we cut through the noise and deliver the essential insights you need to be truly well-informed. Today, we're plunging into a company that really epitomizes both the future of energy and, well, some high-stakes financial drama. Eos Energy Enterprises, ticker EORS. They're pioneering this revolutionary zinc-based battery technology, super critical for our energy future. But yeah, they're also facing a ticking financial clock. So our central question is this: can Eos translate its immense technological promise and, frankly, a multi-billion-dollar sales pipeline into a viable, profitable enterprise before the capital runs out? It's a question with a truly almost binary outcome. And by the end of this deep dive, you'll understand why.
Indeed. EOS is a classic battleground stock right now. We're seeing fiercely contradictory signals across the market, making it an incredibly compelling case study. We'll explore everything from its core business and leadership, through its financials, market perception, and of course the critical risks. Our aim is to give you a complete nuanced picture.
And we're analyzing EOS as of September 13th, 2025, with a reference share price of $7.22. Our mission, as always, is to extract the most important insights from our sources on EOS to help you understand what's really driving this story. Okay, let's kick things off with Chapter 1, Business Analysis. To truly understand EOS, we need to first break down their core business. What exactly are they building, and for whom?
Right, so EOS has an integrated end-to-end approach to energy storage systems. They're not just selling batteries, they're providing complete solutions for pretty demanding applications. Think utility-scale grids, large commercial operations, and industrial users. This means they handle, well, basically everything.
So the revenue streams must reflect that comprehensive approach. Like, it's not just one thing.
Precisely. Their primary revenue comes from product sales. That's their Eos Znyth aqueous zinc battery systems. Big chunk right there. Beyond that, they have service revenue, which is recurring, generated from long-term agreements covering installation, monitoring, maintenance, the ongoing stuff. And then, for those full hands-off solutions, they offer engineering, procurement, and construction, or EPC services. This means they provide complete, ready-to-use turnkey solutions from initial design all the way through to commissioning the entire system.
That makes sense. Now, this is where it gets really compelling, I think, the key product. Tell us about the Znyth battery and what makes it, well, special.
The Eos Znyth aqueous zinc battery is absolutely the cornerstone of their offerings. No question. What sets it apart is its non-flammable water-based electrolyte. Now, this is crucial because it eliminates the thermal runaway risk, that's the uncontrolled self-heating that can lead to fires in some other battery chemistries, meaning greatly reduced fire suppression costs and, just enhanced safety overall. It's ideal for long-duration applications, typically 3 to 12 hours, which is kind of a sweet spot for grid stability. And importantly, it uses abundant recyclable materials like zinc, actively avoiding conflict minerals, cobalt, or lithium. Big pluses there.
That's a huge differentiator, definitely. And I saw they recently launched some new software, something about optimizing things.
Yes, good point. In September 2025, they launched Dawn OS software platform. This is a 100% US-developed battery management system, software, and analytics platform. It's a strategic move to optimize battery performance and also to add high-margin recurring software revenue, moving beyond just the hardware sale. They also bundle these into turnkey energy solutions, so integrated systems that include their batteries, power conversion stuff, and the software platform.
Okay, so with that technology, what kind of scale are we talking about? How big is their pipeline? Is it real?
The scale is significant, or at least the potential scale is. As of Q2 2025, they reported a robust $672.5 million order backlog that represents about 2.6 GWh of capacity. So that provides some solid revenue visibility, assuming they deliver. Beyond that, their commercial opportunity pipeline is massive, $18.8 billion, or 77 GWh, huge numbers. And a substantial 20% of that is linked to the booming data center market, which, as you know, needs reliable, long-duration power. To meet this demand, they're scaling up their manufacturing at their Turtle Creek, PA facility, aiming to double throughput to an annualized rate of 2 GWh per year in the second half of 2025 through automation. That's the plan anyway.
So what does this all mean for the customer? If I'm buying this, what's the core value proposition Eos is selling me?
For customers, it really boils down to 4 key advantages. First, safety, thanks to that non-flammable aqueous electrolyte, eliminating fire risks and, the related costs. Second, sustainability, using abundant zinc, avoiding those problematic conflict minerals, and just offering a greener alternative. Third, cost effectiveness, aiming for a lower total cost of ownership, especially for those longer duration needs. And finally, being American-made is a huge plus right now. It aligns with energy independence goals and benefits significantly from government incentives like the IRA, that's the Inflation Reduction Act's investment tax credits, and the OBBBA production tax credits, which is from the bipartisan infrastructure law.
Right, the government support is huge. If we connect this to the bigger picture, then how do these advantages play into the broader market? Where do they fit?
Well, the market trends are a massive tailwind. Global energy storage is just exploding. Some forecasts project a, 14.7% compound annual growth rate through 2035. It's huge. Utility-scale projects are dominating, driven by grid stability needs, integrating renewables, and that surging demand from data centers and AI. Now, the competitive landscape is fierce. They're primarily up against incumbent lithium-ion technologies, which are themselves shifting from NMC to LFP chemistry that's different, often cheaper and safer materials for stationary storage. But Eos also competes with other zinc-based players, Redflow, Zinc-5, others, and alternative technologies too. The regulatory environment in the U.S. is incredibly supportive, with those federal incentives providing powerful backing. Can't overstate that. Geopolitical factors like potential U.S. tariffs on Chinese imports also could benefit American-made solutions by increasing the cost of competitors. But the barriers to entry are high. You need intense capital, deep technological expertise, and robust supply chains. It's not easy. Eos aims to leverage its competitive advantages, its American-made brand, potential cost advantages from zinc and Project AMAZE, which is their manufacturing scale-up effort, and its unique Znyth intellectual property.
That's a really comprehensive look at their business. Okay, let's move on to Chapter 2, Management Evaluation. Understanding their strategy is one thing, but who's actually at the helm navigating these pretty choppy waters?
Looking at the leadership, Joe Mastrangelo, the CEO, he brings nearly 3 decades of experience from General Electric, so extensive global energy project experience there. He's guided Eos through its SPAC merger and, the initial commercialization phase. But crucially, the appointment of John Mahaz as COO in August 2025. That seems like a potential game changer for their operational execution. He brings over 30 years of global manufacturing, operations, and supply chain leadership from Jabil Inc., which is a massive global manufacturer. He's led facilities to win the prestigious Shingo Prize for operational excellence and even rebuilt manufacturing operations in Puerto Rico after Hurricane Maria. His expertise is absolutely critical, I think, for efficiently scaling Eos's production from, a concept to actual reality.
That COO appointment certainly sounds like a strategic coup, getting the right person for the scale-up. But you also highlighted a potential disconnect regarding communication. While their public narrative is, pretty optimistic, we've seen consistent insider stock sales throughout 2025. And not just anyone, but multiple top executives, including Mastrangelo himself. How do we reconcile that strong operational addition with what seems like, maybe a vote of no confidence from some of the leadership team? What does that signal to investors?
Yeah, it's a significant point of concern, definitely a red flag that investors have to weigh carefully. No getting around that. It suggests a potential mismatch between the public optimism and maybe private conviction. Moving to capital allocation, Eos's strategy is singularly focused on aggressive organic growth. That's it. They're channeling all capital into funding operational expenses, expanding manufacturing through that Project AMAZE and R&D. There's no M&A, no share buybacks, and certainly no dividends, none are anticipated, period. Their return on invested capital, ROIC, is deeply negative right now, which just reflects their heady losses. For investors, the entire thesis hinges on whether these massive future investments can actually generate a positive ROIC down the line. That's the bet. Their financing is entirely dependent on external capital, mostly through dilutive stock offerings, convertible notes, and a structured loan from Cerberus Capital Management that has operational milestones attached. And a significant portion of this capital is actually used to refinance high-cost debt, which just underscores the intense financial pressure they're under.
Okay, time to dive into the numbers with Chapter 3, Financial Analysis. Let's talk about the hard facts, the bottom line, so to speak.
Right. As of September 13, 2025, Eos Energy Enterprises has a market cap of roughly $1.89 billion. Looking at revenue growth, their TTM revenue that's trailing 12 months as of Q2 2025 was $33.8 million. What's crucial to note here is this follows 2 years of declining annual revenue in 2023 and 2024. Not great. So the bullish investment thesis absolutely hinges on their 2025 guidance of $190 million. That would be a tenfold increase over 2024. Massive jump. But again, it's entirely dependent on successfully scaling up manufacturing in the second half of 2025. Big if.
A tenfold jump is incredibly ambitious. Okay, but what about profitability? Are they making any money on what they do sell?
This is where the picture gets really challenging. What's fascinating, or maybe alarming here, is the exceptionally weak profitability. Their TTM gross margin is a staggering negative 307.4%. Let me repeat that. Negative 307.4%. TTM operating margin is negative 627.9%, and their TTM net loss was $818.8 million. To put it simply, for every dollar of revenue, they are losing multiples of that just in costs. It's not sustainable as is. The critical goal, the absolute must-hit target, is to achieve positive gross margins by the end of 2026. Predictably, free cash flow has been consistently deeply negative, TTM negative $217.0 million. This persistent cash burn is precisely what drives their reliance on external financing. For listeners trying to visualize this, is Eos currently burning cash faster than a rocket taking off, or is it more like a leaky faucet?
That's a great analogy. Based on those numbers, it sounds much more like a rocket taking off, but maybe without a clear destination plotted in yet. This really highlights the financial stability question, doesn't it?
Absolutely. Eos has a consistent history of significant net losses. This persistent lack of profitability is, in my view, the single greatest risk factor for the company right now. Full stop. Their debt-to-equity ratio, well, I can't even calculate it because they have substantial negative stockholders' deficit of $570.7 million. Basically, their liabilities significantly exceed their assets on the books. Now, their current ratio of 2.23 looks healthy on its face, right? Current assets, $232.3 million divided by current liabilities, $104.2 million. But you must view that in the context of that high, consistent cash burn rate, which is over $200 million annually. That cash can disappear fast. As for dividends, not applicable. No dividends paid, none anticipated, not even on the radar.
Valuing a pre-profitability, high-growth company like Eos must be incredibly challenging, almost speculative, right? How do we even approach putting a number on it?
It is indeed highly speculative. A traditional PE ratio is meaningless because of the substantial losses. Their TTM EPS is negative $4.54. Their TTM price-to-sales PS ratio is very high, 55.9x. But the market is clearly valuing future potential. The forward PS, using their 2025 midpoint guidance, is closer to 11.1x. Still high, but shows they expect massive growth. For an intrinsic valuation, using a discounted cash flow, or DCF, that's where you forecast unlevered free cash flow, the cash before debt payments. It's exceptionally sensitive for Eos because of the assumptions you have to make. Huge assumptions. You'd have to assume massive, but eventually decelerating revenue growth. You have to assume a dramatic reversal to positive gross and operating margins. And you have to use a very high discount rate, a WACC-weighted average cost of capital of maybe 15–20% because of the extreme risks involved.
So, okay, with all those assumptions baked in, what does that translate to in terms of potential value? What's the range look like?
Well, this leads to a very, very wide estimated value range. A bull case, if everything goes right, might see values between $15 and $20 per share. Some external analyses I've seen go even higher, like 25–50 cents. Our base case sits right around the current price, maybe $7.22, suggesting the market is already pricing in a fair bit of that future potential and risk. But a bear case, if they fail to execute or the market sours, well, could be near zero. This wide range really highlights that an investment in Eos is truly a bet on a nearly binary outcome. Significant success or substantial failure. It sounds less like a traditional stock investment and maybe more like a venture capital bet that happens to be public. For someone considering this, what's the mental framework they should adopt when looking at a company with such high upside, but also, frankly, a near zero bear case?
That's a crucial question. Yeah, you really have to view it through the lens of calculated risk, I think. Betting on the innovation, the tech, more than the established financials right now. Okay, we've laid the groundwork on the company's core business, leadership, and those challenging financials. Now let's explore how the market sees Eos and the unique structure of its ownership. Stick with us. Welcome back. Let's get right into Chapter 4, Market Sentiment. So, what's Wall Street saying about Eos? Are analysts bullish, bearish, confused?
Wall Street analyst sentiment is, well, cautiously optimistic, maybe. The consensus rating is technically buy or bullish.
Yeah.
But, and this is important, 6 out of the 9 analysts covering it actually hold a hold rating. That suggests caution, not exactly strong conviction buy signals. The average 12-month price target is $7.29, which offers pretty negligible upside from the current $7.22. The range is fairly tight too, $5 to $10.
Interesting. So consensus says buy, but most analysts say hold. And what's the general media tone, the recent news impact? It seems like a bit of a mixed bag.
Definitely mixed, yeah. On the positive side, we've seen reports of record Q2 2025 revenue, which is good. Advances on their crucial DOE loan, that's positive momentum. And the strategic appointment of CEO Maha's got good press. But the negative narratives persist. The significant Q2 2025 EPS miss, they lost $1.05 versus a forecast of only a 0.1371 loss. That's a big miss. And there are just ongoing media concerns about the persistent cash burn and the lack of profitability. That story isn't going away.
So if analysts are cautious and the news is mixed, what are the key market indicators telling us? What's the actual money doing?
Okay, this is where it gets really interesting and maybe concerning, depending on your view. The short interest is exceptionally high. We're talking between 29.73% and 32.48% of the public float is sold short. This is a powerful and, frankly, unambiguous bearish signal. It indicates strong conviction among many investors that the price is going to decline. However, that high short interest also introduces the potential for a short squeeze if some unexpected good news hits and shorts have to cover quickly. Creates volatility. On the technical side, though, Eos is currently trading above its 50-day simple moving average, which is around $7.20, and is also above its 200-day simple moving average of approximately $6.66. These are generally considered bullish technical indicators for short, medium, and long-term trends, respectively.
Okay, so what does that tell us? If we connect this to the bigger picture, Eos is a classic battleground stock, right? We have bullish technicals and an analyst consensus that's technically biased on one side, directly conflicting with massive bearish short interest and the company's undeniable difficult financial realities on the other. The market is fundamentally divided on this one.
Totally. Okay, moving on to Chapter 5, ownership structure. Who actually owns Eos, and what does that tell us about investor confidence or lack thereof?
Right. So institutional ownership accounts for about 52.4% of the outstanding shares. A decent chunk. This includes passive managers like BlackRock and Vanguard, who likely own it just because it's in certain indexes. But it also includes active managers like UBS and Dryhouse, who actually been increasing their positions recently. So some conviction there. A key strategic investor is Cerberus Capital Management. They hold a substantial position, mostly through warrants and convertibles tied to their debt and equity investment. They have skin in the game. Okay, so institutions are involved, some actively buying. And how about the insiders, the people actually running the company day to day?
Insider holdings stand at about 7.21% ownership. That provides some alignment of interests, for sure. CEO Joe Mastrangelo himself holds nearly 2 million shares, which is significant.
Yeah.
However, this is where we loop back to that critical and frankly concerning data point, the consistent insider selling throughout 2025. We're talking multiple top executives, Mastrangelo, Croker, Silberman, Walters, all selling shares. This is a significant red flag. It just raises serious questions about management's long-term conviction and how they personally perceive the risk-reward balance. Hard to ignore.
Yeah, that's a strong signal, and it just keeps coming up, doesn't it? Is the ownership concentrated in a few hands, or is it more spread out?
Ownership concentration is relatively diffuse, meaning no single entity holds a controlling stake. The top 25 shareholders own about 41.6% combined, so fairly spread out among the larger holders. A large percentage, though, around 45.7%, is held by retail investors. That's quite high. And that high retail ownership can contribute to stock price volatility as retail sentiment can shift quickly,
We're more susceptible to swings.
Okay, now for a crucial part of any deep dive, Chapter 6, Risk Assessment. Let's lay out the full picture: strengths, weaknesses, opportunities, and threats. The SWOT. Okay, a concise SWOT analysis based on our sources really captures the core dynamics here. Eos's strengths include its proprietary technology, especially those safety and sustainability advantages, experienced leadership, now bolstered by Maha's, strong U.S. policy alignment, that's huge, a substantial commercial pipeline, and that government validation via the DOE loan. The weaknesses are pretty stark. Severe unprofitability, the high cash burn and resulting financial dependency, a weak balance sheet with negative equity, limited manufacturing experience at the scale they need, and, yes, those concerning insider sales. Opportunities for Eos stem from that exponential market growth in energy storage, new demand coming from data centers and AI, geopolitical tailwinds like potential tariffs on Chinese competitors, supply chain diversification efforts, and ongoing technological advancement possibilities. But it also faces significant threats. Intense competition, primarily from Leon, but others too. Extreme execution risk in actually delivering that manufacturing scale-up. Capital market risk, what as funding dries up. Potential negative changes in government policy. And broader macroeconomic headwinds.
That's a powerful overview of their position. On the threat side, you mentioned capital market risks and macroeconomic headwinds. Can you elaborate a bit? How do specific factors like, say, rising interest rates, directly impact a company with Eos's unique financial vulnerabilities?
Oh, they're highly vulnerable to that stuff, yeah. High interest rates directly increase their borrowing costs. For a cash-burning company that constantly needs external financing, that's really detrimental, makes everything more expensive. Inflation also increases their input costs, which eats into already deeply negative margins. So that's another big challenge. However, on the flip side, certain geopolitical factors, like potential U.S. tariffs on Chinese imports, for example, there's talk of a potential 54% blanket tariff on clean energy products. That could actually be a substantial tailwind for Eos. It would increase the cost of its primary Li-ion competitors, making Eos relatively more attractive, assuming they can produce competitively.
Right, so it cuts both ways. Okay, finally, let's bring it all together with Chapter 7, Conclusion. After digging through all this, what's the ultimate takeaway here? What's the bottom line on Eos?
Synthesizing our findings, Eos is truly defined by this stark contrast. You have immense technological and market potential on one hand, and a precarious, even dangerous financial and operational reality on the other. The investment case is highly polarized. It really is a high-risk, high-reward situation. No middle ground here.
Okay, let's quickly summarize those key bullish points first. What are the undeniable positives someone betting on Eos is counting on?
Right, the bullish argument rests on, first, a vast and rapidly growing market for energy storage. The demand is undeniable. Second, a differentiated and potentially superior technology, especially regarding safety, sustainability, and maybe long-term cost. Third, they do have demonstrated commercial traction, with that $672.5 million backlog and the huge $18.8 billion pipeline. Those are nothing. Fourth, Eos benefits from powerful policy support from the IRA and OBBA. That's a significant tailwind. And fifth, they've arguably strengthened leadership for execution with the COO Maha's hire.
Those bullish points are compelling, especially the market opportunity and the tech. But the counter-argument is always that potential doesn't pay the bills, right? So what are the critical bearish points, the risks that keep investors and maybe management up at night?
The bearish points are critical, absolutely. First, the company is in a critical financial condition. History of losses, negative free cash flow, deeply negative gross margins, negative equity, even previous going concern warnings from auditors. That's serious. Second, there's extreme execution risk involved in scaling complex manufacturing. It's hard to do, especially quickly. Third, they face relentless cash burn and are completely dependent on capital markets staying open to them. Fourth, there's overwhelming market skepticism, clearly shown by that 30% short interest. The market is placing a big bet against them. And fifth, those negative insider signals from the consistent selling are a significant concern about internal confidence.
So given that huge divide, what does this all mean for valuation? How do we even think about what this company is worth today?
Yeah, valuation. There's no traditional PE ratio here, obviously. It's speculative, entirely forward-looking. It's a bet on the future. Our DCF analysis, as we discussed, yields that very wide range. A bull case could see values maybe $15 to $20, perhaps even $25 to 50 cents if you squint hard enough. Our base case is around the current price of $7.22, suggesting the market's kind of pricing in the current knowns and unknowns. But a bear case could see its value go effectively to zero if things go wrong.
So it's essentially a make or break bet on a turnaround, on execution.
Precisely. Eos Energy Enterprises represents a high-risk, high-reward speculation. It's essentially, like we said, a venture capital type investment that just happens to be publicly traded. The outcome hinges entirely on operational execution over the next, say, 12 to 24 months. That's the critical window. An investment in EOSE is a direct bet on management's ability to navigate a truly treacherous operational and financial path to capitalize on what is, admittedly, an undeniable market opportunity.
Wow. Eos Energy Enterprises presents one of the most compelling dichotomies in the market today, really. It forces us to ask, in the big race to a carbon-free grid, will the undeniable promise of a breakthrough American technology ultimately outpace the relentless ticking clock of its financial challenges? What truly stands out to you from this deep dive after laying it all out?
It's a powerful question. For me, it's that execution gap. The technology is interesting, the market is there, but can they actually build it profitably at scale before the money runs out? That's the core challenge, and it demands really careful, critical thinking from anyone looking at this company. Bridging that gap is everything.
Well said. Thank you for joining us on this deep dive into Eos Energy Enterprises. We really hope you're now much better informed on this very high-stakes bet. Now remember, this analysis was generated by an AI system for educational purposes only, and it should definitely not be considered financial advice. Please, please conduct your own research or consult with a qualified financial advisor before making any investment decisions. And hey, if you enjoyed this deep dive, make sure to like and subscribe to Stock Analytics AI. For just €499 a month, members get priority access to deep dives on S&P 500 stocks. Over the next few months, we're covering all of the S&P 500 stocks, and members get that exclusive priority access. If you want a one-off deep dive on a specific ticker, just drop us a super thanks. We'll catch you on the next deep dive.